The key to investing is not assessing how much an industry is going to affect society, or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. Warren Buffett, Fortune, 1999. Capital allocation is a term that's as important as it is poorly understood. Business people love to chuck it around, but very few know what it means. As for investors, they may understand it in theory, but most are so obsessed with short-term earnings and growth rates that they give it almost no weight. This is unfortunate, because for both business people and investors, capital allocation is the key to building great wealth. Every financial data point emanates directly from the wellspring of capital allocation. Earnings, cash flow and growth rates are like the waves you see on the ocean's surface. Capital allocation is the deep-sea groundswell that produces them. Capital allocation is in fact simple to define. It's what managers decide to do with the cash available to them. If a company has good allocators, even a mediocre business will prosper. If a company has poor allocators, the best business in the world will eventually founder. No one understands and illustrates this better than Warren Buffett, who 55 years ago bought a struggling New England textile mill called Berkshire Hathaway, and later turned it into the world's sixth most valuable company simply by dint of capital allocation. I own Berkshire for my clients, and the story of how Buffett transformed Berkshire is both a good case study in capital allocation and a good way to show why the stock is attractive today. The birth of Berkshire as we know it. Buffett was a young and hungry stock picker running a series of small hedge funds from his hometown of Omaha when, in 1962, he stumbled upon a struggling, publicly traded New England textile mill called Berkshire Hathaway. Over the previous 15 years, Berkshire had been vitiated by lower-cost competition. It had lost all but 2 of its mills and 80% of its employees. However, it was cheap, its stock was selling at a wide discount to both its net worth, or book value, and its current assets less its current liabilities, or net working capital. Buffett began buying Berkshire shares on the open market and became so intrigued with the bargain that in 1964, he bought a controlling interest in the company through his investment partnership. Soon after, however, Buffett realized that he had made a poor capital allocation decision, making Berkshire the dumbest stock I ever bought, he would later tell CNBC. Although Berkshire was cheap, it was cheap for a reason. It continued to be hammered by low-cost competition. While the inventory was indeed worth something, there was little hope that the business would ever be consistently profitable. It was a classic cigar butt investment, the kind that Buffett's Columbia Business School teacher, Ben Graham, favored. It was good for only a few puffs, there was no lasting value in it. Showing the adaptability he remains famous for, instead of trying to sell Berkshire, Buffett installed new management and instructed them to squeeze the company hard for cash. No more would Berkshire's capital be allocated to looms and mills. I'd rather have a $10 million business making 15% than a $100 million business making 5%, Buffett told his new managers, according to Roger Lowenstein's masterful biography, Buffett. I have other places I can put the money. Those other places, of course, were in fact one place, the stock market. Buffett didn't close the last Berkshire mill until 1985, but by the late 1960s it was clear that the company's future lay not in the textile business but in the capital allocation game. In 1969, Buffett closed his various investment partnerships. Those who wanted to remain invested with him took Berkshire shares in lieu of cash, and the modern-day Berkshire Hathaway was born. Buffett began using Berkshire's assets to buy other cheap stocks, and the proceeds from those winners to buy still more. The Berkshire machine really got going, however, when Buffett began buying insurance companies, not as shares in the open market but as wholly owned Berkshire subsidiaries. As a pure profit proposition, an insurance company faces prospects no rosier than a textile company. Both industries are characterized by commoditization, low barriers to entry and high capital requirements. However, Buffett understood something important about the industry before nearly anyone else did. Until the claims come due, insurers can invest the premiums they've taken in. With so-called long-tailed business, there can be decades between taking in the cash and paying out the claims. The resulting float, as it's called, the cash generated by premiums yet to be paid out, can prove exceedingly valuable in the hands of a good capital allocator. Every year an insurance company must pay out claims, but every year it takes in new premiums, thus ensuring a sort of perpetual motion machine of cash flow. For more than 50 years now, Buffett has invested this float with uncanny acumen, growing and changing as an investor in a remarkably fluid way. Brick by brick, business by business, he has made Berkshire a fortress with many, many moats. It's likely that nobody will duplicate Buffett's capital allocation skills, but that's not necessarily a problem for Berkshire. Buffett has long resisted major stock buybacks at Berkshire because he's confident in his ability to reinvest the cash, but his lieutenants will likely not be so sure. Buffett has raised the prospect that, after he's gone, his successors may return massive amounts of capital to shareholders via both buybacks and dividends. This is no surprise. Buybacks are capital allocation for dummies. You're not doing anything particularly smart with the cash, but you're not doing anything stupid, either. If Berkshire used all its available cash and equivalents to buy back stock, the share count would shrink by roughly 20%, and each share would in turn be 20% more valuable. Who knows? His successors may even spin off Buffett's many acquisitions, unraveling the great tapestry Buffett has woven over the last half-century from a broken-down textile business. This collection of exceptional businesses may well be worth more on their own than as a complicated, somewhat opaque whole. Buffett has acknowledged this more than once, using as he often does equal parts intelligence, clarity and humor. "If I die tonight, I think the stock would go up tomorrow," he told shareholders at the Berkshire annual meeting in 2017. There'd be speculation about breakups and all that sort of thing, so it would be a good Wall Street story.